An operating budget is a financial plan that defines the goals of an organization and the expected total revenue, expenses, and net income to be earned. Operating budgets are crucial for determining the resources managers will be given to complete their work and contribute to organizational goals. Budgets provide a written expression of a hospital's policies and plans in quantitative terms. They serve as a basis for evaluating financial performance in accordance with the hospital's policies and plans. Budgets are a useful tool for controlling costs and creating cost awareness throughout the organization. Operating budgets deal with short-term revenues and expenses necessary to operate an organization, usually covering a 12-month period. Capital expenditure budgets analyze the desirability of acquiring high-cost assets that provide service over multiple years, often lasting 5 or more years. Responsibility centers include cost centers and expense centers, where managers are responsible for controlling costs, and profit centers, where managers are responsible for both costs and revenues. Direct costs are budgeted by the manager, who must account for all costs in their budget, while allocated costs are not budgeted by patient care departments in large organizations. Fixed costs do not change in total when workload increases or decreases, while variable costs rise or fall in proportion to changes in output. The construction stages of an operating budget include planning, gathering information, preparing input, constructing and submitting a preliminary budget, making revisions, and submitting the final budget. Construction elements involve determining the format, budget scope, available resources, levels of review, and time frame. Budget information sources include the operating revenue forecast, staffing plan or forecast, and actual or budgeted operating expenses. When building a budget, data sources can be current year actual revenues and expenses, current year budgeted revenues and expenses, or the last full year of data. Partial year expenses should be annualized to determine what total spending for the year may be. Forecasting approaches include department-level input, statistical information and trend analysis, and executive-level judgment. Revenue forecasts consider utilization assumptions, patient mix assumptions, contractual allowance assumptions, and trend analysis assumptions. Labor and expense forecast assumptions involve expected changes in workload and input prices. The final budget must be approved by the practice owner or senior management and the board of directors in large organizations. Once approved, the new budget should be implemented and its contents explained to all involved personnel, providing training if necessary. Incremental budgets are based on forecasted output and do not change if actual output differs from the forecast. They are easy to prepare when output is predictable. Flexible budgets create a preliminary budget based on forecasted output and are restated at the end of the budget period when actual output is known. They provide more or fewer resources depending on actual output. The steps in building an incremental budget include determining an expenditure base, identifying inflation factors and timing, multiplying the expenditure base by the inflation factor, and modifying for expected changes in output, production processes, and regulatory mandates. An example of an incremental budget is provided in the chapter. The flexible budgeting process involves defining the output measure and estimating budget year output, identifying inputs required, developing productivity and cost standards, inflating cost standards for expected price increases, multiplying budget standards by estimated output, developing budget allocations for fixed costs, modifying for expected changes, and recalculating variable costs based on actual output. An example of a flexible budget is provided in the reading, along with an explanation of how to restate the budget based on actual output. A checklist for building a budget includes questions about proposed output, inflow and outflow relationships, appropriate dollar costs, resource sufficiency, and managerial objectives. A checklist for reviewing a budget covers questions about budget type, expense designations, authority, controllability, comparability, actual and budget amounts, annualization, calculations, and reasonableness. In summary, operating budgets set goals and estimate needed resources for the next fiscal period, providing managers with information to assess budget year performance. Incremental budgeting relies on identifying an expenditure base and increasing amounts for expected price increases, while flexible budgeting adjusts the final budget for actual output. Understanding the budgeting process is essential for managers to gain control over their department's financial performance. The next chapter will demonstrate how managers should examine budget variances to further enhance their financial control.